Hi, I'm Shae Russell from ABC Bullion, and joining me today from the other side of the world is none other than Rick Rule, private investor and speculator. Rick, how are you today?
Life is great, Shae. Thank you. The better for talking to you.
Lovely. Now, I want to get straight into it today. We've got a whole bunch of things we want to cover on precious metals. And as usual, you made some great comments off screen. So I'm going to try and bring them in here today. First and foremost, gold's had a bit of a rough. It's really been a rough, half a year, or actually nearly a full 12 months if we're looking at taking it back to the high of August last year. Now, you've weathered bull and bear markets before. Tell me, do investors need to look at this as the bull market's ended, or can investors find some optimism in this ongoing sell-off?
I think a lot of optimism, Shae. The reasons for a gold bull market you and I have discussed many times. Quantitative easing, debt and deficits, negative real interest rates, all those types of things are still with us. In the very near term, my belief is that around the world, there is enough liquidity in the system and confidence is high enough, and there is enough post-COVID economic activity that the economy at least appears to be in relatively good shape. I would argue that a lot of that's liquidity driven. But the consequence of that is, at least in the United States, that the Fed has been allowed to let interest rates rise, perhaps so they can cut them again if they need to, raising confidence, raising the US dollar, and weakening gold. This has caused a crisis in confidence for some of gold's new adherents, but it's completely consistent with prior gold bull markets. You'll recall, Shae, in earlier interviews, we've talked about the two prior gold bull markets in my experience, the 1970 to 1981 market and the 2000 to 2011 markets. I would draw your viewers' attention, first of all, to the duration of those markets, 10 or 11 years. This one has been intact for 3.5 or 4 years. So when somebody says to me, have I missed the train? The answer has to be, if past is prologue, of course not. The second is dimension. My first bull market was obviously the most dramatic because we came into it with gold being constrained by fiat, price controlled. But the gold price ran in 11 years from $35 an ounce to $850 an ounce. A handsome move indeed. The second bull market might be more constructive, where the gold price moved in US dollar terms from $253 an ounce to $1,950 an ounce. So when people say to me again in US dollar terms, listen, the price has gone from 1,000 to 1,800. Have I missed it? Well, not if past is prologue. If you observe my favorite tool, which is the Barron's Gold Mining Index, what you'll see is that cyclical declines in secular bull markets are frequent and sometimes breathtaking. 15 to 25% downdrafts are common. They're unnerving to people. But a gold bull market wasn't designed to be good for the nerves, Shae. If you believe, like I believe, that gold does well when people are concerned about the efficacy, the purchasing power of their savings, that's my belief. And if you look at the ongoing things like quantitative easing, which, if we discussed before, is really counterfeiting, or debt and deficits, whether in your country or mine, or negative real interest rates, I would suggest to you that the tailwinds are all in place for precious metals and precious metals equities. I would suggest too that the malaise, if that's the right word for it, given the current confidence around the world and given the relative strength of the economy from liquidity, means that gold investors might have psychologically trying times for 6 more months. Not inconsistent, and from my viewpoint, extremely, extremely welcome. If you make money by buying low and selling high, and you intend to be richer over the course of the decade, why wouldn't you appreciate the opportunity to buy more bullion or more gold equities at more attractive rather than less attractive prices?
Now, that's actually where I want to take this conversation next. Now, the Sprott Natural Resources Symposium is coming up in a couple of weeks. Now, I believe it's running from the 17th of July to the 21st of July this year. Now, last year, when I was part of the Natural Resources Symposium, the hot topic was gold. Everybody was so excited about what was happening in the gold market. Do you think we're going to see that same sort of optimism in the gold market this year, or do you think your presenter's attention is going to be focused on something else?
I think the attendees' attention is still going to be focused on precious metals. The Natural Resources Investment Symposium is meant to cover any resource class that we find attractive. But the truth is that we have been talking to our own audiences about precious metals more aggressively than we've been talking about other natural resource commodities. And to be honest with you, Shae, I know you've probably noticed this in Australia too. Very recently, the precious metal that is garnering the most attention has been silver. In the Sprott universe, we have become the largest buyer of good delivery physical silver in the world. And the consequence of that is that silver has stolen gold's luster, at least in the near term. Sorry.
Okay.
So I suspect that the topic which will garner the most attendee interest will be silver. As you know, Shae, this is a conference that's been around for a very long time. And I think that you'll see attention paid to a wide range of commodities. I think that certainly this year, I'm going to be talking a lot about the opportunity in oil and gas equities, as an example. I've been, as you know, a very vocal proponent of the uranium market. Unfortunately, the junior uranium equities have performed too well. I can't talk about them with a straight face anymore. They've doubled or tripled before the uranium prices moved. Probably my own fault on social media, I don't know. But I suspect, in direct answer to your question, that precious metals will garner most of the attention, and silver in particular will garner attention.
Look, we're going to touch on the silver conversation just a tiny bit. Now, I know both you and I have spoken about silver quite a bit in the past 12 months, and perhaps it's silver's fault. Silver gets no love for a few years, and then it comes out of nowhere, has a rally, and excites investors. Is there a bigger silver rally ahead, or do you think that the dust has settled on the silver price for now?
I'm of mixed minds about that. I think that the younger Reddit-style investor has done something that I consider to be impossible, which is they've actually tightened the physical silver market. I wouldn't have believed for a very long time that 2 million young people with cell phones could do what the Hunts couldn't do. But there were 2 million of them, and they were unleveraged. They didn't have to worry about margin calls. So they've in fact done it, which is interesting. What's more interesting to me is, some number of them will drive on. Some number will think this is sort of GameStop on steroids. They'll get bored and drive on. But 2 or 3 million young people have been introduced to the silver topic and the precious metals topic as a consequence of this, coming to understand that, precious metals are in fact real money. And I suspect that this will affect real changes in the silver and the gold market. 2, prior experience tells me that the second half of a precious metals bull market is silver dominant. Precious metals bull markets are led by gold because it's a fear buyer that takes gold out of the doldrums. But when the narrative is established by momentum, the silver narrative is stronger than the gold narrative. That's why they call it poor man's gold. And I suspect that the latter half of this bull market, which I think we're coming into, will be a circumstance where silver moves both further and faster, perhaps goosed, if that's the right phrase, by this move that we've seen in the physical market by these younger newcomers to the market.
Now, I don't want to steal too much thunder from what you're going to be talking about at the Natural Resources Symposium in July, but I just want to draw on something you did point out, is that you're going to be looking at oil and gas equities during this conference. Now, that's sort of a contrarian viewpoint right now. What's drawing your attention to that sector?
Shae, simple arithmetic. You've got the big thinkers of the world, Biden and Merkel and whatever that young economic superstar's name is, Greta, I think her name is, who are anti-oil. But the rest of the world has a different viewpoint. Oil is the most efficient motor fuel in the world. We will hit peak oil demand somewhere around 2045. But right now, sustaining capital investment in the oil business is not enough to maintain current supplies. And as demand continues to increase, albeit slowly, and supplies falter, the price will do very, very well. Your listeners, when they think about the efficacy of that statement, need to ask themselves a simple question. In 5 years, assuming that they're not multimillionaire Tesla owners, they walk from their bedroom to the garage and they turn the key to the right, will the car start? Because if the answer to that is yes, then the price of oil has to stay above the incentive price to produce it, which is to say $55, $65, $70 US a barrel. And if the price remains above $65 a barrel on a free cash or net present value basis, global oil and gas equities are still very, very cheap. Better yet, while you wait for good things to come to the oil markets, these things pay dividends that are triple the market dividend. So you need worry less about the time value of money waiting for the oil market to change, because the oil and gas companies pay dividends that are, as I say, 3 times the market average. It takes the sort of pain out of the time value of money thesis.
All right, so I'm actually going to move on to a much unloved sector, or not an unloved sector, it's a sector that doesn't get enough attention. And I am going to quote you on this. So we're going to start talking about PGEs, or platinum group elements, in particular, palladium and platinum. Now, off camera, you made a quote. I said that you were obviously an early mover in this sector, and you pointed out that you were so early, you were wrong.
That's right. Sometimes if you go in straight arithmetic, it's one of my faults, Shae. I'm linear. I believe if this is true and this is true and this is true and this is true, that the logical conclusion is X. Sometimes I confuse in English 2 words, inevitable and imminent. The move in PGEs was certainly inevitable, but as I learned to my chagrin, it was not imminent. Sometimes you have to work a decade to be an overnight success, and I suspect that's what's happened with regards to palladium. It's important to note that PGE metals are important contributors to our quality of life in the West where we can afford it, because their primary application is in air quality, reducing the harmful impact of emissions from internal combustion engines. And in that sense, electric vehicles ultimately notwithstanding, for the next 25 years, most of the world's going to be burning internal combustion engines, and we will need to deal with the effluent from that. You don't see, I don't suspect, in Australia, crowds of young people with signs saying more smog, more smog, more smog. So the demand side of the platinum group elements is very, very much intact. The supply side is what's curious. Most of the PGEs in the world come from 3 countries: South Africa, not the model of stability; Zimbabwe, almost not a country; and Russia, which of the 3 is a paragon of stability. But if you were to experience social or political disruption in any of those markets, you would see markedly tightened PGE supplies. And I would argue higher prices. The reason that I would argue higher prices is that it takes a reasonably small amount of platinum and palladium, platinum and or palladium, to populate an internal combustion engine that allows the sale of an expensive car. In the United States, as an example, about $125, $35 to sell a $50,000 or $60,000 car. If the price of platinum and palladium were to double, it wouldn't change the shelf price of that automobile. So in the near term, demand is very inelastic with regards to price. And if you shut down production in any of the markets that I've described, I suspect you'd see a price explosion. I'm not saying that Russia's going to blow up, or South Africa is going to blow up, or Zimbabwe is going to blow up. I'm just saying that the production of those elements is really constrained to countries that are, let's just say it's not Western Australia.
But not only that, with the platinum and palladium conversation, we're talking about aging infrastructure, particularly in South Africa. So surely that old mines don't have a great track record of being stable in that part of the world. So surely aging infrastructure at some point is going to come into play. And do you think that could constrain the supply of these precious elements further?
I do, Shae, and you've pointed out something that probably needed pointing out. the political and social realities of South Africa are such that the government is much more interested in redistributing wealth than generating it. The consequence of that is that title, taxation, ownership, all of that kind of thing in the mining business in South Africa is extremely tough. And that means that the South African miners have been loath to invest capital in productive facilities that they might not own. They have been substituting labor for capital, which is popular in South Africa. But the fact that they haven't been investing as much in the labor force or enabling the labor force to employ much capital means that the laborers that they are hiring are severely skilled and severely underpaid. And this is not a recipe for success. It's a bad mining pun, but the industry is stuck between a rock and a hard place. They need to upgrade these mines, but they don't dare upgrade the mines. They need to employ more capital per worker, and they need to greatly reduce the labor force, which is a circumstance that's politically impossible in a country where Black youth unemployment exceeds 65 or 70%. It's a very, very difficult circumstance. The managers of those mines, in particular, Neil Froneman from Sibanye-Stillwater, I mean, these people are magicians. They deserve absolute medals for making South Africa work for as long as they've been able to make it work. But the potential for another social blow up, given the state of the mine workers, listen, their wages have to go up, but they can't. The industry has to invest more in the mines, but they can't. These are really ugly conundrums. It's odd that the sort of shiny paragon of the platinum and palladium industry is Norilsk in Russia, which has had certainly its own challenges with regards to pollution and other circumstances. But the point you make with regards to supply is a very, very, very good one. Mines don't benefit from neglect, and that's what has had to happen in South Africa.
Now, I'm just going to circle back. Unfortunately, I did have a follow-up question before on your upcoming Natural Resources Conference. Now, I know you're not allowed to say you have a favorite, but is there, they're like our children, but is there any chance that there is a speaker that you are most looking forward to from hearing from your conference this week, in the next 2 weeks?
Shae, now that it's Rick Rule's conference, not Sprott's conference, who's going to fire me? Me? My favorite feature of the conference is easily the Living Legends panel.
Yeah.
In the Living Legends panel, we interview 4 or 5 people who have built multi-billion-dollar companies from scratch. And we don't allow them just to sort of beat their chests, but rather we ask them questions about how they built the company, how they outcompeted others, how the lessons that they learned building the companies made them better investors, and how the lessons that they learned can make other people better investors. I think that this has been the most valuable part of the conference for the last decade. And if you'll allow me a brief commercial, I'm so certain of this that any of your listeners who take the time and attend the conference, if they don't think they got their money's worth, particularly out of the Living Legends panel, I'll refund them their purchase price, no questions asked. If you don't think the conference was worth the money you spent to be there, I'll make it worth it because I'll return your money to you. It's something we've done for probably 20 years. We've probably had to refund people 3 times. So from my point of view, it's a very low risk effort. But from somebody else's point of view who might be a skeptic about a conference that they've never been to, particularly the Living Legends panel, I'm not talking about these big picture gurus who, talk about the impact of the Fed on something or else, or bitch about COVID ad nauseum. I'm talking about people who have built multi-billion-dollar companies and how their experience can affect your portfolio. This is really good rubber meets the road stuff.
I'm actually going to second that. So I've interviewed a half a dozen people from your conference over the years, and I've always thoroughly enjoyed the Living Legends panel simply because I found the people who participate are raw. They don't, for lack of a better word, they don't put lipstick on a pig. They genuinely, they make jokes about how, they got booted out of a certain country because they didn't read the rules right, or they give insight that they wish they had themselves 20 years ago. So I will second you and people watching on that it is absolutely something that they should participate in, especially too, if you're interested in the commodities sector, because as you pointed out before, you cover quite a broad, you cover all commodities. And, we've talked quite heavily on precious metals today, but essentially you could argue that we're in a broad commodities bull market and it's beginning right about now. And you're obviously going to delve into this topic during your conference, aren't you?
We will. Absolutely. On the series of discussions that you and I have had, we've talked in the past, and we'll deal with at the conference, the fact that society as a whole has underinvested in natural resources for as much as 3 decades. The exploration expenditures have been constrained. The development pipelines have become much tighter. And frankly, the challenges that we face in terms of the social take, which is to say taxation and non-tax distributions from mining and permitting, will combine, I think, inexorably to create supply shortages. Yes, I think that demand will continue to increase, but I think the real story 5 years from now will be around supply. If you look in your own country, Shae, to increase your production of base metals, the most obvious project there would be Olympic Dam. The current budget for the Olympic Dam upgrade is something like $15 billion before permitting. It's a fairly large tag there. In our country, we have a great copper deposit, not as good as Olympic Dam, but we have a great copper deposit called Resolution, discovered 15 years ago. It's at least 10 years away with regards to permitting, financing, and building. It probably won't produce copper for 15 years. And we're running into those circumstances in commodity after commodity after commodity, in country after country after country. And so I think it's inevitable that the supply and demand lines are going to cross and cross reasonably dramatically. And I don't think in the near term there's very much we can do about it. Perhaps commodities right now, like copper, are ahead of themselves because we're in what I think is a liquidity-induced economic boomlet. So it wouldn't surprise me to see copper go lower before it goes higher. But make no mistake, with the whole world wanting to be electrified, I'm not talking just about Teslas. With the whole world wanting to be electrified, demand for copper isn't going to decline, it's going to increase. And this is not a copper commercial, but I'm using it to illustrate a point. We have been underinvesting in copper exploration, copper development for decades. The mines that we live on now, Grasberg, Escondida, 40-year-old mines, Chuquicamata, 100-year-old mine, Bingham Canyon, 100-year-old mines. These mines are all past their prime, and you don't stand at the mine mouth and throw in water and fertilizer and have them grow more copper. That's not the way it works. So I suspect, for better or for worse, that we're headed into a pretty good market.
All right, that's fantastic. Now, I am going to have to leave you there. We're nearly out of time today. But before I do, I believe you have an offer for everybody listening today.
I do. I really enjoy the ABC audience. I enjoy talking to them, to give them an inducement to talk to me. Any of your listeners or subscribers who go to a website, sprottusa.com/rankings, I will rank your natural resource portfolios 1 to 10, 1 being best, 10 being worst. By the way, no pot stocks, no cryptocurrencies, no technology stocks, just things I might understand. I'll comment on individual issues if I think my comments have some value. And if in the request you mention the word charts, I will send you the Barron's Gold Mining Index that Shae and I talked about today. And I'll also send you the Goldman Sachs Commodities Index, which talks about the price of commodities versus other asset classes going back 100 years. Once again, sprottusa.com/rankings.
All right, we will make sure we put a link to that in the comments below. Rick, once again, it was an absolute pleasure to see you. I hope you have a fantastic conference. I know everybody who attends will. I'm that confident in it. And I look forward to speaking with you again.
Always a pleasure, Shae. And next year when the conference is live, I expect to see you back in Vancouver.
Absolutely. Thanks, Rick.
Thank you.